In 1990, the middle class controlled the majority of the American economy. Today, that balance is collapsing. According to projections based on research from institutions like Vanguard and BlackRock, the share of wealth held by the American middle class has been shrinking for decades, and the trend is accelerating into 2026. Not because people suddenly stopped working, not because productivity disappeared, but because the rules of the economic system have quietly changed. Today, the economy rewards ownership far more than it rewards labor. And if you look closely, the signs are everywhere. Housing is becoming harder to afford. Debt levels are reaching historic highs, and millions of households are working harder than ever just to maintain the same standard of living. The question isn't whether the middle class is under pressure. The question is why this is happening right now and who is benefiting from it. Because once you understand the forces behind this shift, you start to see that the disappearance of the middle class isn't random. It's the result of powerful economic trends reshaping the global economy. 2026 economic context. To understand what's happening, we need to look at the economic environment entering 2026. The era of ultra-cheap money that dominated the 2010s is over. Interest rates have stabilized around 4.5%, according to current Federal Reserve projections. At the same time, governments are investing heavily in infrastructure, industrial reshoring, and energy systems. Global capital is flowing towards sectors tied to real economic production: manufacturing, energy, logistics, data infrastructure. Meanwhile, everyday households are facing a different reality: higher borrowing costs, more expensive housing, and rising living expenses. According to several institutional outlooks, including research from Goldman Sachs and Vanguard, this environment favors investors who control productive assets. But households relying mainly on wages face increasing financial pressure. This creates a widening divide between two groups: people who own assets and people who depend primarily on income. And that divide is one of the biggest drivers behind the shrinking middle class. Pillar 1. The housing wealth divide. For decades, homeownership was one of the most reliable paths to middle-class wealth. Buying a home allowed families to build equity while benefiting from long-term price appreciation. But that model is becoming increasingly difficult to access. Over the past several years, housing prices have risen significantly faster than median incomes. At the same time, higher mortgage rates have dramatically increased the cost of financing a home. Let's look at a simplified example. A $400,000 home financed at 3% interest results in a dramatically different monthly payment than the same home financed at 7% interest. In some cases, the difference can exceed $800 per month. That difference alone pushes homeownership out of reach for millions of potential buyers. And here's the important part. When fewer people can afford to buy homes, more households remain renters. Meanwhile, institutional investors and real estate funds continue acquiring residential properties. This creates a long-term shift. Instead of building equity through homeownership, many households are now paying rent into institutionally owned housing portfolios. Over time, that dynamic transfers wealth upward. The $1,000 growth model. Let's look at a simplified illustration. Imagine two individuals. One invests $1,000 per year into a diversified real estate investment fund earning 7% annually. Over 10 years, that investment could grow to roughly $13,800 with compounding. Now compare that to someone who never participates in asset ownership and instead spends that same $1,000 on rising rent costs. One person is building equity. The other is simply covering expenses. Over time, that gap becomes enormous. And when millions of households experience the same dynamic, it reshapes the entire wealth structure of the economy. But housing is only the first layer of the middle-class squeeze, because the second force reshaping the middle class is happening inside the labor market itself. Automation, artificial intelligence, and productivity technology. And the impact of these forces may be even more disruptive than rising housing costs. Pillar 2. The technology productivity gap. Technology has always reshaped economies, but the current wave of automation and artificial intelligence is moving faster than previous industrial shifts. Companies are using AI systems, automation platforms, and digital tools to dramatically increase productivity. This allows businesses to produce more output with fewer employees. For companies, this is extremely efficient. For workers performing repetitive or easily automated tasks, it creates new pressure. Highly specialized roles in engineering, data science, and advanced technology are seeing rising compensation. But many middle-income roles are experiencing slower wage growth. This creates what economists call a barbell economy. Income growth at the top, income pressure in the middle, and expanding low-wage service work at the bottom. Over time, this hollowing out effect gradually erodes the economic stability traditionally associated with the middle class. But housing costs and automation are only part of the story. The third force behind the shrinking middle class is something that sounds harmless, but quietly reshapes purchasing power across the entire economy. Inflation. And when inflation collides with stagnant wage growth, the results can be financially devastating for middle-income households. Pillar 3. Inflation and the purchasing power trap. Most people think inflation simply means prices going up. Groceries cost more. Rent increases. Gas prices fluctuate. But inflation is far more powerful than that. Inflation slowly reduces the purchasing power of wages. And when wages fail to keep up with rising costs, something dangerous begins to happen. The middle class starts to shrink. Let's break this down with a simple example. Imagine someone earning $60,000 per year. If inflation runs at 4% annually, but wages only grow at 2%, that person is effectively losing purchasing power every year. It may not feel dramatic at first, but over time, the difference compounds. In 10 years, the same salary buys significantly less. Housing becomes harder to afford. Healthcare costs increase. Education expenses rise. And what used to feel like a stable middle-class income begins to feel increasingly stretched. This is what economists call the purchasing power trap, and millions of households are already experiencing it. Inflation doesn't affect everyone equally. Households with large asset portfolios often benefit from rising asset prices, but households relying primarily on wages feel the pressure first. And when inflation persists over multiple years, the financial pressure builds quietly. But inflation alone doesn't erase the middle class. The real shift happens when inflation interacts with another powerful economic force: asset ownership. Because in modern economies, assets rise faster than wages. And that difference is where the largest wealth gaps emerge. Pillar 4, asset ownership versus wage dependency. Let's step back and look at how wealth is actually created. There are two primary ways people generate income: labor and assets. Labor includes wages, salaries, and hourly work. Assets include things like stocks, real estate, businesses, and infrastructure investments. Historically, middle-class families were able to combine both. They earned wages while gradually building asset ownership. But over the past 2 decades, asset prices have accelerated far faster than wage growth. For example, the stock market has delivered strong long-term returns. Real estate prices have surged in many regions. Private equity and venture capital investments have generated massive wealth for early participants. Meanwhile, wage growth has remained comparatively slow. This means individuals who already own assets see their wealth increase rapidly. Those who rely primarily on wages struggle to keep up. Over time, this creates a widening financial divide. And that divide is one of the key reasons the middle class is shrinking. Let's look at a simple example. Imagine someone invests $1,000 per year into a diversified index fund, earning an average 8% annual return. After 10 years, that investment could grow to roughly $14,500 with compounding. Now imagine someone who never invests and instead keeps that money in cash savings. Even in a high-yield savings account earning 4%, inflation could significantly reduce the real value of that money over time. The difference between asset growth and cash savings becomes enormous over long periods. And when millions of households fail to participate in asset ownership, the wealth gap expands across the entire economy. But even though the pressures on the middle class are real, that doesn't mean the outcome is predetermined, because understanding the system allows individuals to adapt, and that's where risk management and long-term strategy become essential. Risk management and 2026 outlook. Every economic cycle creates both winners and losers. The key difference usually comes down to positioning and risk management. One of the most important concepts in investing is the margin of safety. This means investing in assets where the potential downside is limited relative to the upside opportunity. For example, companies with strong free cash flow, low debt-to-equity ratios, and consistent earnings growth. Investors also benefit from diversification. Owning assets across multiple sectors reduces exposure to sudden economic shocks. Because unexpected events, what economists call black swan events, can always occur. Examples might include geopolitical conflicts, global supply chain disruptions, energy price spikes, or sudden liquidity crises in financial markets. These events can create temporary volatility, but long-term investors who maintain disciplined strategies often navigate them successfully. And historically, periods of economic transition also create new opportunities. New industries emerge, new technologies reshape productivity, and new sectors begin attracting capital. Understanding these shifts early is one of the most powerful advantages any investor can develop. So, why is the middle class disappearing in 2026? The answer comes down to three structural forces. First, housing affordability is deteriorating, making it harder for households to build wealth through real estate. Second, technology and automation are reshaping the labor market, compressing many traditional middle-income roles. And third, asset prices are rising faster than wages, creating a widening gap between owners and earners. None of these forces operate in isolation. Together, they reshape the entire economic landscape. And while the pressures on the middle class are real, understanding the underlying dynamics gives individuals the opportunity to adapt, because financial systems reward those who recognize change early. If you want to stay ahead of these economic shifts, check out the 2026 Economic Dashboard linked in the description. It tracks key indicators like inflation trends, housing affordability, and sector rotation across the stock market. And here's a question I want to leave you with. If asset ownership continues outpacing wage growth over the next decade, do you think the definition of the middle class will change completely? Or will new economic opportunities rebuild it? Let me know your thoughts in the comments, because the conversations happening right now will shape the financial future of the next generation.